great to see so many of you here, some familiar faces as well. So, I mean, we speak about regulatory change, and Steve touched upon that. And obviously here, before we look to the future, there are some lessons to learn from the past. Because I think, specifically this event's about fixed income, FX, and looking at that from maybe a high-level view and potentially what changes will happen. And I think it's pertinent to look at the equities markets and how they evolved in the US and Europe as well, and some of the key milestones. I mean, this doesn't capture all of them, but it certainly captures some of the key ones, because from that I think we can try and predict or discuss what will potentially happen as some of these other markets, like fixed income and OTC derivatives, then become more electronic as well. I mean, electronic trading in the US has been around for a long time. I mean, NASDAQ's been established since 1971, and actually before that, and that was as an exchange, but before that you actually had institutional networks like Internet that have been around since 1969 as well, as a buy-side network, almost ahead of its time. And then, as we moved forward, we saw the move with Big Bang and the UK market away from floor trading to screen-based trading, albeit it was still quote-driven as well, and that was an important change. I mean, all of a sudden the whole dynamic changed, and there was no longer a trade floor as far as that was concerned. And in the US, I mean, obviously we've still got a NYSE floor, but the market really opened up, the equities market anyway, in the mid-1990s, because with NASDAQ, they suffered an antitrust investigation where they were investigated with the dealers having wider spreads than there should have been in the market. And on the back of that, the SEC made some stringent changes where NASDAQ were then forced to open up their market to other competing trading venues and have those prices visible alongside theirs, and that kind of spawned something called Regulation ATS in '98, where some of the other VCNs that then on the back of that were created, like ARCA, Internet became an electronic communication network as well. You had Ireland on the back of that, that they were also allowed to become exchanges as well. And that really spawned a great deal of competition in the US, and ultimately those venues started interconnecting, and we got things like smart routing and things like that. And I think the traditional exchanges like NYSE didn't really envisage what would hit them at that time. I mean, they're very blasé about potentially, new young upstarts, almost, in the case of Ireland that came a bit later, almost two men and a dog in a room, out of a garage that sort of built a faster and better system. And even Internet had become the incumbent by that time. If we look at the late 1990s, and Internet had about 33% of the NASDAQ market share. NASDAQ were there sort of looking at Internet behind their shoulder, because Internet was more nimble, was able to react to change, and all of a sudden Ireland then came along and started to steal Internet's lunch. And they started at 5%, then moved up to 10%, then 15%, and all of a sudden they were at 20%, and Internet was at 20% as well, in the early 2000s. And Internet were forced to buy Ireland, and it's the Ireland management that almost did a reverse in and ended up running Internet, and that's how the iNet business and the Internet brokerage business were split out as well. And no one could have seen that coming, sort of as Internet on the back end of that, and no one saw that there'd be that rate of change so rapidly as well. And we have cases before that as well. I mean, if we look at Deutsche Terenbörse, the sort of precursor to Eurex, that was established in 1990, again as an electronics exchange, more nimble than Life, less headcount, more efficient, very technology driven, and of course in '97, a month or so after SETS went live and we moved to order-driven trading in London, the liquidity that Life had, which in the German government bond that accounted for about a third of their revenues, just disappeared to Eurex almost in a matter of a few months, or DTB as it was called at the time. And it happened, DTB ticked up to 10% in the bund, 20% in the first half of the year. All of a sudden, October time, 50%. By the end of the year, all that trading had migrated, and that was on DTB. And that was a real wake-up call for Life as well, because Life then felt that actually we drastically need to go electronic, because they've eaten our lunch on one contract which we thought would never move, was shifting the open interest and everything like that, and there hasn't been a case since as well. And then life moved electronic, and that resulted in the floor closing in 2000 with Live Connect coming in as a platform as well. So again, technology ended up being a disruptor, but then what was seen to be the incumbent had to attack and fight back as well. And then more recently, in '97, MiFID, the original MiFID directive went live. That was in equities. I was at Internet at the time, and we saw that as a real opportunity for us, even in '95 when the draft directive was out, because everyone was out there panicking across cash equities, thinking, well, how are we going to comply with the new directive? What are we going to do? We're going to need to hire lots of compliance people, lots of risk people, although I guess in some assets that still isn't addressed. And they were looking at all of that, and we in '95 thought, actually, this is exactly what happened in the US when we created the US business, and sort of Internet and Ireland came about, and we started working on Chi-X, which is called Internet Chi-X at the time. I remember going in 2006 into the LSE, and David Lester will remember this there, and he still laughs about it today. So the three of us are called in. This was sort of Tony Mackay, the CEO of Internet Europe at the time, myself and Peter Randall, who was the CEO of Chi-X at that time. We were called in. We thought we were going to see David and Martin Graham, who was their director of markets at the time. They took us up in the lift. I'm sure it was the exclusive lift that Clara used to use at the time, but we went up in the lift, and we ended up in the boardroom, and all of a sudden there were 32 people around the boardroom, in everything from the senior execs, bar Clara, to sort of middle management and the account management team, because they all wanted to hear what we had to say. So we were very blasé, because it's almost sort of a street fight, and we're the new kid on the block, David and Goliath, and we said, so they said, what are your plans? Because at that time it was a weird situation, because Internet was a member of the LSE as well. So we were now trying to be a competing venue, but we had to actually go to the exchange and seek permission to do it, because it was all pre-MiFID at the time. And we explained our plans. It's all very good, and there were a few sniggers in the room. And at the end of it, sort of Peter turned around and said, well, we are hiring, so if any of you are interested, why don't you come and join us? So then we got 3 CVs by the time we got back to the office, actually, which was quite encouraging. We hired one of those guys, Jerry Avenel, who joined us in business development and did very well. And of course the rest is history, because what happened then was 5%, 10% liquidity, and all of a sudden we got to 10% of the UK market, and then it snowballed quite quickly, and we got to 15 and 20 quite quickly soon after. And now, I think the media reported that as of last month, in terms of volume, the Chi-X was kind of forging ahead as far as the LSE was concerned, and especially in continuous trading with the pan-European market. The exchanges didn't see that coming, but the good thing was, on the back of it, they then started to innovate, because the LSE, you could argue, would never have got in the Millennium system and upgraded their platform and reduced all their costs, and got to a stage where they are now if that hadn't have happened. And that spawned a raft of other new entrants as well, because not just in equities, because then you had, there's a corporate bond platform called Vega Chi that was created a couple of years after that, no relation to Chi-X, although a little bit ahead of its time. And now what's interesting is with MiFID 2, it's not just covering equities, it's going to cover a multitude of asset classes. And with that, and we'll look at regulation later. But now there's even more opportunity across some of those sectors, some of which you could argue are even pre-Big Bang, because if we look at aspects of the OTC derivatives market, we look at, I guess we look at rates, and we were talking about that. We look at credit and the way that a lot of these trades are calculated over a number of days and done on spreadsheets, and there's a lack of connectivity into risk management systems, aside from whatever people tell you, and there's a few grins in the room. And so all that's set to change, and obviously technology can help as an enabler, and obviously there's regulation, but there's even more panic in the room now, but with that it brings even more opportunity, in my view. So if we look, this is a study that IT Group did earlier on in 2011, and they mapped out, and this is for the European markets actually, the level of the market that is electronic, and that's electronic can be broad range. It could be anything from algorithms to high frequency trading to some level of connectivity, broker to broker, and we could quibble with the numbers, but this is sort of the best representative sort of comparable set of facts and well, set of figures that I could get out there. And obviously, as we know, equities is a mature market. It's commoditized as I see it. Margins have dropped and there's been a steady decline. Again, no surprise given as the market's become more electronic and more open, that's led to effectively margins coming down and being squeezed, etc. And it's a relatively mature market. P&Ls being squeezed there as well. That's not to say there isn't opportunity, but it's very much high volume, low margin. And if we look at that now in the US as well, I mean, we've had a good level of volume in the futures markets and also the options market. So the opera feed in the US for US options is the most high volume market in the world. Yet we haven't had that same level of volume in European options or even equity options and that kind of area. But a lot of the high frequency trading houses that come into equities now, whether we think high frequency is good or bad, and we'll kind of talk about that a little bit later. I mean, they're looking at some of these other asset classes options. But the next one, I mean, obviously we know the FX market is highly distributed, and but to a degree, if you compare the technology there, if you look at EBS, for example, again, I mean, the technology with EBS is antiquated when you compare that to the types of technology being used in equities to drive equities volumes, whether it's the latencies, the volume handling, everything to do with that, the architecture of those systems. But it's pretty obvious.